The emotions of fear and greed are easily the two most dominant emotions in the world of stock market or in the world of money in general. Like all things, these two should also be perfectly balanced. But sometimes greed overpowers all senses. And in those times, it becomes impossible to resist the get-rich-quick schemes. Getting into futures and options without any experience, buying homemade currencies that could one day replace the dollar, and investing in stocks growing very fast for no reason are some of the things we fall prey to during those moments of greed. I recently came across an extremely fast-growing stock. $1,000 invested in this stock in the June of this year would have become $10 million by November. With that kind of returns, a person can go from being homeless to living in his own luxury villa in a few months. Nothing can trigger greed like the possibility of getting rich like this in no time. For reference, let's understand that an annual return of 26% can multiply an investment by 10 times in 10 years, by 100 times in 20 years, and by 1,000 times in 30 years. Considering most young people in their 20s can easily have a 30-year investment horizon, this is a very good and realistic rate of return if the goal is to create generational wealth. A capital of 10 lakh rupees will become 100 crores, but a return of 7 million% in a few months is definitely better than 26% CAGR over a period of 30 years. And that is because of the principle of time value of money. $1 million in the bank today is much better than $1 million 5 years later. Any delay in receiving profits is a lost opportunity for growth. 1000x return in 30 years is good. The same in 10 years is better. And if it happens in a few months, then the time value of money just went through the roof. But the important question for retail investors is what can go wrong with expectations of such high returns. Namaste and welcome to Retail Investing. So sometime in the year 1981, this entity gets incorporated under the Companies Act of 1956 and becomes a company. And to be specific, a non-banking financial company, also called an NBFC. There are many famous NBFC stocks which have multiplied investors' wealth over the years. Bajaj Finance, Bajaj Finserv, Shriram Finance, etc. NBFCs as a business are quite simple to understand. They are very similar to banks in the sense that they are in the business of loans and advances. But there are a few differences between banks and NBFCs. Firstly, NBFCs are not allowed to deal in savings accounts or any other kind of demand deposits. Secondly, they are not allowed to issue checks. And thirdly, deposits in NBFCs are not insured. In case of banks, deposits of up to 5 lakh rupees are insured. Once, banks were pretty much the only option for most people to borrow money for buying things. But in the last 10 to 15 years, NBFCs have grown so much that today their stability has an impact on the stability of the overall economy. And for that reason, any NBFC with assets of more than 500 crore rupees has been categorized as systemically important NBFC, meaning the government might make efforts to save them if they are in danger. So here we have the history of the stock price. In the July of 2011, the company gets listed on the stock market at around 12 rupees a share, and after that it stabilizes at around 3 rupees by 2016. Then for almost 8 years the price does not move at all, but 2024 turned out to be different. The share price goes from 3.5 rupees to 2 lakh rupees in just 129 days, then to 2.6 lakh rupees a share in the next 4 days, and finally touches 3.3 lakh rupees a share in the next 7 days on the 8th of November. That, my friends, is 100,000x returns in just 140 days. But investing is not just about the price action. It is about understanding the business behind a stock and the causes for those price movements. Do the financial statements even justify the price movements? So here we have the profit and loss statement. For revenues, the company has two main sources. Firstly, dividend income, from which 110 crores came in. And secondly, net gain on value changes, from which 122 crores came in. Dividend income and value changes happen in stocks. And this NBFC is basically a holding company. Holding companies do not make any product or service or sell anything of their own, and they do not have business operations either. All they do is own stocks of other companies, and no stock held by this company has moved up this much. So the business fundamentals do not explain the price movements, but something else might. Here we have the shareholding pattern. As you can see, the directors hold 1.5 lakh shares and only 15,000 owned by outside individuals, and only 2 lakh shares in total are available. This is a case of extremely low float, and it can be seen in the daily traded volumes as well. This is the stock activity on a particular trading day. Only 598 sell orders send the stock price down by 5%, and 5% is the lower circuit for this stock, meaning if price falls by 5% in a day, no more selling will be allowed. Price discovery becomes a big problem with low float. Whenever there are not enough buyers and sellers, retail investors get trapped, and unrealistic high returns often come with unexpected high risks. The risks may be associated with the business operations or with something else entirely. In this case, it's clearly liquidity risk. Using the analytical mind is extremely important while making investing decisions. The business model, the sector, and the financial numbers can be analyzed, which is called fundamental analysis. The stock's volumes, momentum, and moving averages can be analyzed, which is called technical analysis. But the most important one is a bit of psychological analysis of the investor himself. Whenever an investment opportunity comes forward, we need to ask ourselves a simple question: what emotion does it invoke? If the answer is too much greed, then it is better to assume there is a red flag somewhere. So here we have the financial overview. The name of the stock, the code on Bombay Stock Exchange, the price 2.2 lakh rupees a share. The book value is almost 7 lakh rupees a share. And to reach its book value, the stock still needs to multiply more than 3 times. But there is more. The entire company is valued at under 4,400 crore rupees, while it has cash reserves of 13,000 crore rupees. Too much undervaluation there. But the obvious problematic part is the average weekly buy and sell volumes, which is only in hundreds. This, for example, is a very well-established stock, Reliance Industries. The average weekly volume is in millions, hundreds of millions. That is the kind of liquidity we need for safe and sound investment. Undervaluation in a stock would not even matter if it is not possible to sell. And for that reason, I'm out.